Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Tuesday, January 13th, 2026, and US markets just threaded a very narrow needle. The S&P 500 managed another record close, up just a fraction, but this was no victory lap. Institutional desks spent the day repricing the Department of Justice's criminal probe into Fed Chair Jerome Powell as a direct shot at central bank independence. That shock kept risk appetite muted, even as the benchmarks stayed in the green. Under the surface, money quietly rotated, positioning for the next wave of political and legislative catalysts instead of celebrating the new highs. If you look at the S&P 500 heatmap, the story gets clearer. This wasn't a sea of green, it was blotchy. Consumer staples like Walmart and Costco and the big healthcare names showed that classic calm, defensive green. A few mega-cap tech names helped, but even the AI leaders were split, with Nvidia and Apple stabilizing while Microsoft and Meta lagged. The real warning lights flashed in financials. Banks like JPMorgan and the big payment networks sat in heavy red, masking just how cautious the tape really was under those record index prints. That breadth picture feeds straight into the bigger context. Today felt less like a fresh leg higher and more like a late-cycle reshuffle. Big, liquid defensives and a narrow band of AI names did the heavy lifting. Financials, small caps, and rate-sensitive cyclicals quietly bled, even with the Dow and the S&P near records. Options markets and social feeds were full of dark jokes about rug pulls, but there wasn't outright panic. Think rotation and hedging, not capitulation. The market is effectively saying, we'll stick with the growth and AI story for now, but only if we can hide in structural winners while we wait for the next data print or policy headline. Away from the hard data, the chatter tape was busy, and even though a lot of it's unconfirmed, it's still moving sentiment. Traders swapped takes on Trump's comments about big tech needing to cover soaring data center power costs, with desks speculating about what that might mean for Microsoft, Nvidia, and the broader AI cloud complex. At the same time, the silver ETF, SLV, turned into a meme in its own right. After a violent run-up as a macro hedge, retail traders obsessed over intraday whipsaws and alleged margin changes. None of this is settled policy, but the talk itself is shaping how people hedge and how much conviction they really have in these crowded fear trades. Tesla's heading into earnings season under growing pressure. Vehicle margins are still under strain, competition's intensifying, and Tesla's no longer the world's largest EV producer by volume, which increases the risk of a weaker earnings narrative. But while investors focus on near-term results, a separate and potentially more consequential catalyst is coming up. On January 13th, a U.S. House committee will hold a hearing on new automotive legislation, including the Self-Drive Act of 2026. One key proposal would raise the annual cap on vehicles operating without human controls from roughly 2,500 to as many as 90,000. If it's approved, that would materially expand Tesla's ability to deploy Cybercab and full self-driving services at scale. In the short term, Tesla's still judged as a car company, but this regulatory decision could influence whether investors start to value it as an autonomous AI platform instead. Microsoft was one of the few mega caps that just couldn't keep up today. The stock lagged, while traders fixated on Trump's comments that big U.S. tech players like Microsoft should pay their own way for surging data center electricity. That's chatter, not policy, but it goes straight to the heart of the AI and cloud margin story. With Microsoft now central to both themes, any hint that its cost structure could be squeezed has an outsized influence on how investors view the entire AI complex and, by extension, the broader indices. Nvidia sat right in the middle of today's tug-of-war. The stock swung from red to green and back toward flat, even with the S&P at record highs. That choppy tape captures the tension between investors locking in big gains and believers in the longer-term AI supercycle. Ongoing scrutiny of so-called circular financing and crowded positioning only adds to the fatigue. What stands out is that satellites like CoreWeave and other AI infrastructure plays are still whipping around on headlines, while the flagship itself struggles to extend. That's a sign this core AI trade's getting tired, even if it isn't broken. CoreWeave was one of the purest expressions of speculative AI appetite today. The stock ripped higher, helped by upbeat research and public pushback from management against accusations of circular financing tied to Nvidia. Traders increasingly treat CoreWeave as a high-beta proxy for private cloud AI infrastructure, the kind of name fast money uses when it wants extra juice beyond the mega caps. That surge, right as the broader AI complex shows signs of fatigue, highlights how capital's still hunting for the next leg of the theme, even while investors grow more selective about valuation and leverage. Oklo sat at the crossroads of two of the market's biggest obsessions, AI and energy security. The stock traded actively after it announced a major nuclear power agreement with Meta to support AI data centers in Ohio. That deal gave investors a concrete example of the emerging nuclear for AI theme, where next-gen reactors are pitched as the answer to data center power demands. Oklo has quickly become a speculative focal point for investors looking beyond traditional utilities, even as Meta's own stock underperformed. It's a clear reminder that the market's starting to price not just AI software and chips, but the energy backbone underneath them. The iShares Silver Trust, ticker SLV, offered a case study in crowded hedges. After a violent 2-week spike to fresh highs, driven by a weaker dollar and Fed risk anxiety, the ETF reversed sharply intraday. Social feeds lit up with retail traders complaining about margin hikes and whiplash moves. The key takeaway isn't just the pullback itself. It's how quickly sentiment snapped on a trade, many viewed as a simple macro hedge. Today's action showed just how fragile these shiny rock positions can be when policy headlines or margin settings shift even slightly. JPMorgan, the bellwether for U.S. banks, slipped in a way that mattered more than the price change alone. On a day when the S&P 500 and the Dow hovered around records, JPMorgan and the broader bank complex traded heavy red on the Heatmap. Traders are reluctant to add cyclical balance sheet and deal cycle exposure ahead of earnings, especially with the Powell investigation and curve uncertainty in the backdrop. With major bank results due in the coming days, JPMorgan's weakness is a clear tell that big money's quietly dialing back financial risk rather than pressing it into the prints. On the other side of that rotation, Walmart and Costco quietly did a lot of work. Both stocks traded firmly, matching the S&P Heatmap's solid green in consumer staples. In a market fretting about political shocks and policy uncertainty, these big-box cash flow machines are classic shelters. Investors are signaling they'll pay up for predictability and pricing power, even at record index levels. That resilience reinforces the idea that this isn't a broad, risk-on blowout. It's a late-cycle market hiding out in quality while the policy story plays out. Looking ahead, the tape's rotating toward tomorrow's catalysts rather than yesterday's news. On the micro side, the House hearing on the Self-Drive Act, with proposals to lift caps on human-less vehicles to 90,000, is drawing fresh attention to AI mobility and compute-heavy infrastructure plays. On the macro side, early bank earnings, upcoming housing and inflation data, and the evolving Powell investigation and tariff rhetoric remain front and center. None of these are priced as done deals. They're potential triggers. For now, the market's trying to use AI and autonomy as high-growth offsets to a darker political backdrop, but that balance can shift quickly on the next headline. To wrap up, today's session showed just how thin the tightrope has become. The S&P 500 and the Dow are still printing or flirting with records, but the leadership holding them up keeps getting narrower. Defensives and select AI names are doing the heavy lifting, while financials, small caps, and other cyclicals quietly fade. With the Powell probe, new tariff noise, the self-drive debate, and bank earnings all lining up, markets are less about fresh economic data and more about how politics and policy reassign the winners. We'll be back tomorrow to see whether that tightrope holds or finally starts to wobble. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.